The title of this explainer comes straight from a really important research paper. And believe me, it does not pull any punches. Trading is hazardous to your wealth. Now, that's a pretty bold statement, right? So let's dig into the evidence and see if it actually holds up. So our story really kicks off with this legendary quote from Benjamin Graham, the father of value investing. For decades, this has been a cornerstone of investing wisdom. The whole idea is that our own behaviors, our emotions, our constant itch to do something are the very things that end up sabotaging our own success. But is that just a nice, catchy phrase, or is there real hard data to actually back it up? Well, that's what we're here to find out. We're going to play detective and follow the evidence from a study that put this exact idea right under the microscope. Okay, first up, the investor's dilemma. Why on earth is it so incredibly hard for the average person to consistently beat the market? It's a question that plagues a lot of people. So, to find the answer, we have to go inside the broker's books. The researchers, Barber and Odin, got this unbelievable, unprecedented access to real account data from a huge brokerage firm. This let them see exactly what investors were actually doing with their money. And look, the sheer scale of this investigation is just incredible. This was not some small survey. Barber and Odin analyzed over 66,000 household accounts over a 6-year period. They sifted through more than 3 million trades. Seriously, this is one of the most comprehensive looks ever at how individual investors really perform. And this brings us to the high cost of action. Because as the researchers started digging through all that data, they stumbled upon their first really shocking clue. It all came down to the relationship between how often people traded and how much money they made. So their method was actually pretty simple, but it was incredibly powerful. They just divided all those households into 5 groups. You can think of it like this. On one end, you had the investors, who basically never traded, the buy and hold crowd. And on the other end, you had the hyperactive traders, the ones who are constantly buying and selling. And the results were just staggering. Over that 6-year period, the overall market returned a very healthy 17.9% per year. The least active traders, well, they did even better, pulling in 18.5%. But the most active traders, wow, their return was just 11.4%. The conclusion here is just undeniable. The more they traded, the worse they did. We're talking about a performance gap of 6.5%. The most active traders were underperforming the market by a massive 6.5% every single year. That is a huge difference, and it just begs the question, what in the world was going on here? Now, you might be thinking the answer is obvious. You're probably saying, well, the active traders must have just been terrible at picking stocks. But this is where the investigation takes a really surprising twist. Yeah, the common assumption is they underperformed because they were just bad stock pickers. But the research found the exact opposite. The stocks they picked, they actually performed really well during this period. Before you factor in any costs, their returns were great. So if their stock picks weren't the problem, what was? The real culprit has a name, turnover. And it's pretty simple. It's just a measure of how often an investor trades in and out of their portfolio. Low turnover means your buy and hold type. High turnover, well, that means constant activity. And the turnover for the most active traders was just astronomical. Over 250% per year. Think about that. That means they were replacing their entire portfolio more than twice every single year. All of that buying and selling generates transaction costs, commissions, spreads that just eat away at returns. Their good stock selection was being completely wiped out by the sheer cost of all their activity. So, okay, we know what happened, but the bigger question is why? Why would people trade so much if it was so clearly damaging their wealth? Well, this brings us to the motive, the overconfidence trap. So the paper looks at 2 competing theories. First, there's the rational model. This says people trade more because they think their special information is going to lead to returns that are high enough to cover all their costs. But then there's the overconfidence model. This one suggests that investors simply overestimate their own skill, which leads them to trade way too much and end up with terrible net returns. And as we've already seen, those high turnover traders did not earn higher returns before costs. Their performance was pretty unremarkable. So the only explanation that really fits the evidence is overconfidence. They traded because they mistakenly believed they knew better, that their knowledge would lead to amazing results. But the data shows it just didn't. But you might be thinking, well, hang on.
Could there be other reasons? Maybe they needed cash, or they were rebalancing, or trading for tax purposes. The researchers checked all of that, and those explanations just don't hold up. For instance, the turnover was also incredibly high in tax-deferred retirement accounts, where selling for a tax loss makes absolutely no sense.
And that brings us to our final section, where the verdict is delivered. We've come full circle, right back to that original quote from Benjamin Graham. This summary table just lays it all out, crystal clear. Look at that direct relationship. The least active group, with almost no turnover, had the highest net return. The most active group, with that crazy 250% turnover, had the lowest return by a long shot. It's really simple. The more you trade, the less you keep. And so, the researchers themselves conclude with this incredibly stark warning, the very title of their paper. They write, "Our central message is that trading is hazardous to your wealth." It really couldn't be any clearer than that. So the key takeaway from this entire investigation is simple, but it is so powerful. It wasn't bad luck, and it wasn't even bad stock picking that hurt these investors. It was their own behavior. For the average person, more trading activities simply leads to less wealth. Period. And that leaves us with one final and maybe pretty provocative question. This isn't just about data from the 90s. This is about timeless human behavior. If all this evidence so clearly shows that we are often our own worst enemy when it comes to investing, then the most important question we can ask ourselves is this: what can we do to get out of our own way?